Imagine waking up in a world where your wealth quietly grows, working tirelessly behind the scenes while you enjoy the freedom you've always dreamed of. No more worrying about paychecks or job security, just financial peace of mind. Sounds too good to be true? Think again. The jingle of loose change in your pocket is replaced by the satisfying chime of dividends landing in your account. Picture a life where financial security isn't just a distant hope, but a reality within your reach. But here's the kicker. Most people are making critical mistakes with their dividend investing strategies, costing them thousands of dollars in lost opportunities. Are you making these same mistakes? Stick around because we're about to unveil the secrets to building a dividend portfolio that could provide you with a steady $2,900 per month or $35,000 per year. Before we dive in, ask yourself, are you ready to take control of your financial future? Let's get started. Ever thought about how small, consistent investments could turn into a financial goldmine? Meet Sarah. She's a busy mom with barely any savings, yet she turned $100 a month into a six-figure dividend portfolio, all thanks to the power of dividend reinvestment. Imagine growing your wealth while you sleep. That's what Sarah did, and so can you. Here's how it works. Instead of spending dividend payouts, Sarah reinvested them to buy more shares, creating a snowball effect that grew her wealth over time. Let's break it down. Say you invest in a stock with a 3% dividend yield. In the first year, you'd earn $36 in dividends on a $200 investment. But by reinvesting, you get more shares. Fast forward 5 years, and that same investment could grow by 25% without adding a single extra dollar. And here's a surprising fact. People who reinvest their dividends see portfolio growth 2-3 times faster than those who don't. Are you reinvesting your dividends, or are you letting your money sit idle? Sarah's success didn't happen overnight. It took discipline, patience, and the right approach. But with dividend reinvestment set to automatic, she barely had to think about it. Stick around, because up next, we'll reveal the biggest mistake dividend investors make. One that could be holding you back from serious profits. You're scrolling through stocks, and you spot a company offering a 15% dividend yield. Tempting, right? Think again, because this could be the biggest mistake new investors make. Sarah learned the hard way that high yields often come with hidden dangers. Companies offering sky-high yields might be in trouble, and those dividends could disappear overnight. Let's take a real example. Remember General Electric? In 2017, its dividend yield hit an enticing 4.7%. Investors thought they were scoring a great deal, but by 2018, GE slashed its dividend by 92%. Ouch. On the flip side, companies like Johnson & Johnson, which have steadily increased dividends for decades, offer more sustainable long-term value. So, how do you avoid falling into the yield trap? Look beyond just the yield number. Analyze the company's financial health, cash flow, and dividend payout ratio. If a stock's yield seems too good to be true, it probably is. Ask yourself, are you chasing high yields, or are you investing for consistent, reliable growth? The answer could make or break your portfolio. Coming up, we'll show you how to build a portfolio that pays you every single month, without taking on unnecessary risk. Imagine checking your bank account and seeing fresh dividend payments rolling in every month. Sounds like a dream, right? Well, it's entirely possible with the right strategy. Sarah cracked the code by selecting dividend stocks with different payment schedules, ensuring she received money every month, just like a paycheck. Here's how she did it. She divided her investments into 3 groups. Group 1 pays in January, April, July, and October. Companies like Johnson & Johnson and Coca-Cola. Group 2 pays in February, May, August, and November. Think Procter & Gamble and Microsoft. Group 3 covers March, June, September, and December. Walmart and McDonald's. By carefully structuring her portfolio, Sarah ensured a steady income stream month after month. She also took advantage of tools like dividend calendars and stock screeners to find the best dividend stocks that fit her goals. Want to build your own dividend machine? Start by tracking dividend payment schedules and diversifying across different payout periods. Next, we'll explore how to protect your dividends when the market takes a downturn. Because, let's face it, the market doesn't always go up. Picture this: the stock market crashes, your portfolio is deep in the red, and panic sets in. But guess what? Those dividend checks? They keep coming in. Sarah's portfolio was built to withstand market downturns. She focused on defensive sectors like consumer staples, healthcare, and utilities, industries that thrive even when the economy stumbles. Let's look at some real-world examples. During the 2020 market crash, Procter & Gamble raised its dividend by 6%, while Johnson & Johnson continued its 50-plus year streak of increases. Here's the takeaway: investing in companies with strong financials and a history of paying dividends through thick and thin is the key to surviving market volatility. Want to recession-proof your portfolio? Focus on companies with low payout ratios, strong balance sheets, and a track record of consistent dividend growth. Up next, we'll reveal the ultimate strategy to predict which companies are most likely to grow their dividends in the future. What if you could predict which companies will increase their dividends before they do? It's possible with one simple metric: the payout ratio. Sarah learned that companies with payout ratios under 50% and strong earnings growth are prime candidates for dividend increases. The lower the payout ratio, the more room there is for future growth. For example, companies like Microsoft and Visa maintain low payout ratios, meaning they have plenty of room to boost dividends year after year. Another key indicator: free cash flow. Companies with high free cash flow have the flexibility to pay and raise dividends consistently. Want to identify future dividend growth stars? Look for low payout ratios, steady earnings growth, and a track record of consistent increases. Imagine having a portfolio full of future dividend growth champions. That's the goal, and it's entirely within your reach. Finally, let's bring it all together and talk about the roadmap to your own dividend success. You've now unlocked the secrets to building a dividend portfolio that works for you, whether you're just starting out or looking to refine your strategy. Imagine a future where dividends provide a steady passive income stream, allowing you to live life on your own terms. Sarah did it, and so can you. Here's your action plan to get started today. Start small. Even $50 a month can snowball into something huge over time. Diversify smartly. Choose companies across sectors and payment schedules. Stay consistent. Reinvest dividends and let compound growth do the work. Your journey to financial freedom starts now. Take that first step, and before you know it, your dividend empire will be thriving. So, what's stopping you? Let's build your dividend future today.